Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Hello, and welcome back to the Second Bite Podcast. My name is Todd Taskey, and I'm your host. And on this podcast, we interview entrepreneurs and CEOs that have built and successfully exited 7 to 8 figure businesses. I think people really like the podcast because we focus on businesses that people probably haven't heard of, but have accomplished something very successful in their endeavors in business. And we get a chance to do a deeper dive with them and to learn from their mistakes and from their successes. Today with me, I have Jeremy Wise, who is the CEO of Rise 25, a very successful entrepreneur himself, who spends most of his time interviewing other successful CEOs and entrepreneurs. Jeremy, happy to have you with us again.
Thanks for having me. I'm always excited to chat because we're going to talk about, you get a lot of questions around before selling, while selling. And one of the big questions is people are sometimes worried, are they selling too soon? And so we're going to explore that. We're going to explore in a case study on that. We're also going to explore a cautionary tale on that. And then we're going to walk through it step by step. Before we go through it, this episode is brought to you by Potomac Business Capital. And if anyone knows Todd, if you have an agency and you want to sell it, you go to Todd, all right? That's the bottom line. And I was listening, Todd, to one of your past clients talk in an interview, and they called you the lion tamer because you have to work with both sides to really navigate this whole process. And so if you have thought about selling or you want to sell, contact Todd and his companies. Over 15 years experience with strategies for M&A advising, exit planning, guides his clients through the whole entire thing. So you can email Todd at potomacbusinesscapital.com or just go straight to their website. So Todd, this question, right? And there was a company, Rule Tech, and they were worried that they were selling too soon. What was in their mind when they came to you?
Yeah, so we got introduced to them. So to set the stage, Rule Tech is in the BPO, business process outsourcing space. And their primary technology, they're a partner with Pegasystems. They're in their early 40s. They built a real good business, mostly 3 and 5 year contracts. They're about $2 million of EBITDA. And so there's 2 owners to the business. And when I spoke to them, they said, when we look into the future, we see steady growth, more profit, bigger company, more valuable company, unless it's not. And then I don't know what, but in the technology space, preferences change pretty quickly. Technologies come and go. So we're pretty sure it's going to be more valuable, but what if it's not? And that was their big concern at the time.
But they were growing, so they're worried if they sell too soon and they keep up this trajectory, maybe they're selling themselves short.
Yeah, they would leave too much money on the table, right? From that standpoint.
So how did they find you? When they came to you, were they ready to sell or was it an initial discussion?
They were kind of ready to sell, but had convinced themselves that they didn't want to. They were just unsure, I guess. And somebody had suggested that they contact us. As you know, we do a lot of work in the digital space in that $2 to $5 million EBITDA range. And so, it turned out we obviously had a great result for them, but that's how we got initially connected.
For a company like that coming to you, Todd, they're unsure, they could walk away or not. Is it better to work with a more motivated seller than that, as opposed to, they may be choosier or pickier?
That's a great question. And so what I've found is that we focus a lot on what we call solving the second problem, right? And so the first problem is money. How much money do we get? And you can calculate that, and that decides. The economics is a math equation, so you could figure that out. But the second problem is, whatever it is for that entrepreneur, right? It's sales, it's balance sheet, it's distribution, it's investment, it's whatever the bigger challenge is. And so as an example for our guys, they were under 10 million in revenue. BPO services you sell to large enterprise, 3 and 5 year contract. And nobody ever says to you, we're not picking you because you're small. They always say, oh, we like Accenture's solution better, or IBM's better for us, or whatever the case may be. But they solved that problem overnight. And their sales, they dramatically, and we can talk about this as we go, they dramatically outperformed on their earnout numbers and how much they earned on the back end of their deal because their fit was so good and because solving for the second problem was so good.
Talk about the fit in the second problem in this scenario.
So first of all, the buyer was a company called Incessant Technologies. They're a U.S. company owned by a public company out of India, right? And that has some maybe issues of its own or some concerns of its own for a lot of U.S. buyers. And so they acquired the business. And because they are now a part of a global company with a large balance sheet and plenty of size, the issue of them being large enough went away for many of their clients. That was number one. Number two, NIIT was the holding company, the public company in India. They had a bunch of inbound interest from customers, specifically around Pegasystems, and they didn't have expertise for it. And so that expertise, in having that expertise in the US, created additional inbound. So, from that standpoint, our clients did pretty well.
Yeah, I think one of the other episodes we talked about what makes a really good strategic partnership fit. So people can check out that episode, and there's certain criteria that will not only be a great result for the company being acquired, but for the company buying them too.
Yeah. And then we also solved for the first problem, which was, are we selling too soon? By the way the deal was structured. So we came up with this formula to value the company. And roughly the formula went like this. It was 8 times EBITDA times 0.6 plus 2 times revenue times 0.4. So 8 times EBITDA was 60% of the value, 2 times revenue is 40% of the value. That's how you value the company. The buyer, NIT, bought 55% at close, 12.5% next year, 12.5% next year, and then 20% at the end of the third year. But it was based on the formula in each of those years. So if they continued to perform really well, they would get a bigger and bigger number. And I remember my guy said, Todd, for maybe the first time in my life, I know every question on the exam and I know the date that they're going to give the test. We will kill it on this deal. Absolutely going to kill it. And I knew we had a good buyer when the buyer said, boys, I hope you do. Because when we write that last 20%, if it's twice the amount of money, you know who owns the other 80% of the business?
Exactly.
This would be fantastic for us. So when we did our projections, we projected 20% a year over each of the 3 years. And we did 27% in the first year. We did 35% in the second year. The third year ended May of COVID, so May of 20. So we were scheduled to do something like 40-something%, and we still wound up almost at 30% growth. And so those numbers mean the total amount that we thought we were going to get, we exceeded that because of the performance. And the performance was so strong because of how good that fit was.
What is the reason why some deals aren't structured like this? If the people aren't staying on, like in this situation, did the founders stay on board for the whole time?
Yeah, a lot of buyers are definitely going to want especially in a service business, they want the seller to stay on board. So some buyers just can't get out of their own way when they think about, God, what if we paid this much? And we tell buyers all the time, the more you pay them, the better the deal is for you. Why wouldn't you want to pay an unlimited amount? If I was selling you dollars for 20 cents, you would say, I'll take them all. If I said we're out of the 20-cent dollars, now they're 30 cents, would you say I'm not going to buy them anymore? Right? Of course, you would continue to buy them. So, but especially in a larger organization, sometimes, it doesn't click for them.
They can't look past that sometimes.
They want to have a hard limit on here's the maximum amount that we would pay, because they have to report to their shareholders, to their stakeholders, their private equity backers, whatever.
What are some of the concerns that companies have when they're being acquired by an international company?
The same as they would have, but really being acquired by any company. And the biggest one is culture. And so when you have a different culture from the culture you're used to, that concern gets heightened. And specifically in this case, there was. So you protect that, or you guard against that, A, based on deal structure, and B, based on your legal documents. So we had an operating document that said that they couldn't change. Very specific, said the things that they couldn't change in terms of our operating procedure. Of course, things are going to change on your reporting functionality, especially from a financial standpoint and from others. But those are the biggest things.
So they were able to get past this. We're selling too soon because, listen, if you blow your numbers out of the water in 1, 2, 3 years, you're going to be collecting more. Is there anything else? I want to talk about, not all deals work out. And so I want to talk about another scenario where a deal did not work out. But in this specific instance, are there any other important points to make around what happened with RuleTech?
Yeah, I think what I said to the entrepreneurs at RuleTech, and actually, I think we're going to have Mark on a future episode. And it's interesting now because he's still at the company, although he's done his 3-year earnout. So you can hear directly from him on a future podcast that'll be coming up soon. And I think that the way that I framed it to him is to say, if your company is X valuable, and we don't really know how much it is, you think it's something, I think it's something, the buyer thinks it's something else. But if you could be assured you'd get probably 95% of that, and you'd get 70 or 75% of it right now, would you give up that little bit on the very upside if you knew that you could keep everything you'd get today and there was maybe better certainty that you'd earn the rest? And that was really, to put it in a nutshell, the decision he made. Now, at the end of 3 years, it turns out we didn't give up that little bit, the upside. We got even more than the upside because of how well it fit. But I think as an entrepreneur, to use one analogy would be like the homeowner's insurance you have on your house, right? Let's say your house is worth $1 million. It's a big part of your net worth. Would you give up $1,500 a year so that nothing bad ever happens and that house burns down and you've lost $1 million of net worth? Would you give up a little fraction of the upside? And I think when posed with that question, oftentimes the answer is, yeah, maybe that makes sense for me. But it doesn't make sense, in my opinion, if the only part of the equation is the economic part. It has to be that second problem that we talked about. And if you can solve for that, then I think you come to that conclusion.
So not all deals work out, right? So there was a digital marketing company that you were doing some work with.
Yeah.
And what happened there? Different company.
Yep. So this going back a couple of years. Really good CEO, very, very good business, probably $1.6 million, $1.7 million of EBITDA. I had done some of my finest work, I thought, right? We got a great offer for that business that was just over 7 times, about 7.25 times on EBITDA. They got 100% paid at close, 80% in cash, 20% in equity in the company. The company is private equity backed, a great group out of Chicago. This company's in California. And my client wanted to get paid on the future EBITDA, not their historical EBITDA, and we just couldn't quite bridge that gap. So we never got that deal closed. So then, I don't know, I guess it was 2 years later.
So both parties walk away in this situation.
Yeah, it just didn't come together, right? My client felt like if he had more of a sales infrastructure, they could really grow the business, because that's one of the things that private equity always focuses on. So I reached out to the buyer, that same buyer, 18 months or so later with another client. I said, geez, I think these guys are a good fit. He said, you know what, Todd, unless there's 6 million of EBITDA, we can't go that, we don't have the time. I was like, wow. And they've really grown well. And I said, I really wish our guy would have made a different decision a couple of years ago. And he responded back to me and said, Todd, I'm really glad he didn't, because we would never pay that much money for a business like that today. And so it wouldn't have been a mistake, but gosh, I think we would have really overpaid. So I thought about it a lot. And then I sent that email to my client. Not, as I said to him, I don't want to rub your nose in this, but I think it's important that you understand so that we can make good decisions whenever you want to do a transaction in the future. And he said, yeah, I think I might have wished that I made a different decision as well. Growing a sales infrastructure is hard. Building it's always hard, right? And so I will say he's improved his business. His business is getting better. It probably would have been a quicker, more dramatic outcome had he done the transaction. But these are the parts that make it really tricky. You just never know what that will turn into.
So outside of taking that deal, was there anything else you think he would have changed, or that when you talked to him?
It's interesting because there is a process, and I'll call it a little bit of a maturity process, not a personal maturity process, but a understanding the deal in the marketplace, that guys that have done a transaction once have. And it's understanding a little bit less about myself and a little bit more about what's best for this company, because this company is a living, breathing organism that has 75 people or 50 people or 30 people or 150 people. And it's an asset that I've created. Some people look at that as a reflection of the entrepreneur themselves. And that's why it's so difficult many times for them to give that up. And other times they see it for what the market sees it at, which is a great asset that has a value determined by the market. And if they want to do a fair exchange for that and also create a great, second bite of the apple, then, that's what they do.
Yeah, I guess when, there's two scenarios, right? Both were worried they're selling too soon or they want to get the maximum value. One went with it, structured a deal that seemed great for both parties. The other one, it seemed good also, but it just wasn't enough for them to consider it. And sometimes it's tough just to keep growing in the same trajectory, right?
It is. And I will bet you that he'll do a transaction eventually. I would bet you it'll be a very successful one because he continues to grow a successful business. And I think when that final chapter is written, it'll probably be a story that says, I passed on this. I went through a couple or three difficult, challenging years, but here was the great reward for me at the end, right? I don't think in that particular case, it'll be, oh my gosh, and now the company's blown up and it's not worth anything.
Right.
So I don't think that's going to be the case.
I remember one of the people you worked with, Wes, talked about at one point, there was a great outcome, but he said, even if there wasn't, he said the learning process alone was valuable. Just going through that. What was he referring to?
There's a couple of things. I have I guess you call them a client. It's a group I work with in Philadelphia in the digital space. And we went through a process for them, and they kept hearing from people that we spoke to repeated the same 3 or 4 issues in each presentation, and most companies were coming back at 5 or 5.5 times on EBITDA. And they learned, not from me, because it doesn't matter what my opinion is. It only matters the guys with the checkbook. And so, as I say to clients all the time, the very, very best consulting you could possibly get is going through this process, right? Because those guys don't care about your feelings. Those guys aren't looking to get a check from you. Those guys don't want to retain you as a client. They're going to very agnostically look at your business for what it can produce and how reliable that income is and where your margins are and their other KPIs. And they will be very blunt with you about what that is. Anyways, these guys in Philadelphia, and this is now, going back 3 years ago, and they said to me, Todd, if you ever want a recommendation or an endorsement for somebody you didn't close a transaction for, we'd be happy to do that. And I always joke with them that fortunately I have other people I've been successful with that I can get to do that. But they have since, literally, their EBITDA is almost double. Their revenue is now completely recurring revenue. And now they're like, man, I don't think we want to sell the business. Everything's going great, So,
what do you say to that? Do you say sometimes when you don't want to sell is maybe when you should sell, and sometimes when you want to sell is not when you should sell, or what?
It's just freaking hard to know.
Yeah.
Right.
It's sometimes personal too, I imagine. Like there's life things.
Yeah, it is. And I'll tell you, you don't get clarity until you stand on, the edge. And when you look down over the abyss, or whatever you want to reference it, you get clarity. And some people say, God, this is a fantastic result for me. We'll have a bunch of these people on, future episodes. And occasionally you get some that say, my God, now I think I see what I want to do. I've heard over and over and over again, these 3 things are what people hate about my business. I can fix these things. It might take a year or 2 or 3, but if I fix them, I'll have such a better business and it will be more valuable, and on and on and on, right? If you're in the digital marketing space, I believe you've got plenty of time to do that. I don't think there's going to be a revolutionary technology that will change how people do digital marketing. I think if you're doing BPO work around Pegasystems and Oracle comes in or Microsoft comes in and gives something away and destroys that industry quickly, right, you're at a greater risk all the time. So you might not have as much time as you would wish. But those are the things it's amazing. The clarity that you get from having others critically look at your business will clearly make you a better CEO. And it will allow you to, as I always tell clients, if you don't do a transaction, if you don't want to do a transaction today and you want to wait 2 or 3 years, you're going to work really hard during those 2 or 3 years. I suggest you work on the things that will make the maximum impact in valuation when you want to sell. And I'll give you my opinion on what those things could be, but I know where the truth lies, and it lies out there in the marketplace. If we want to go talk to those people, we can do that.
What are some of those things that you've seen people get feedback on that they had to change? It's kind of similar, I guess, like you were saying about the homeowner's insurance or the house. Like if you redo whatever, the wood floor in the basement as opposed to the master bathroom or master bedroom, the value of the house may increase for one and not for the other. So I'm curious, what is that lever that you've seen people time and time again say, you need to step it up with this that will increase the value?
A lot of times it's recurring revenue. How much of your revenue is recurring? How much of it, what's your retention look like? Right. And then there's so those are a couple of the basic things that you get right away. And then, there's other things that are beyond your control, such as, I don't want somebody that does HubSpot. I want somebody that does Marketo, right? That because we already have strength here, we don't need this. I don't need somebody that does paid media. We want somebody that does earned media. And so there's, that's the beginning of that decision tree that buyers make. But in almost any business, the more recurring, the more reliable your long-term income is, the better it will be. And then, it just gets more nitpicky down the road, right? What is the retention with your clients? What is how, being in a good place to work, one of the best places to work, really important for people, understanding what the culture is like, understanding all those things that are the reason oftentimes one business gets 8 times EBITDA and the other gets 6.
Todd, this has been great. I don't know if there's any final thoughts, or I know there's one person that you work with that you work alongside with that we should mention that helps you on some deals. But I want to point people towards other episodes of the podcast. Check out PotomacBusinessCapital.com. I don't know if you want to briefly mention them.
It's the people at E. Cohen. So E. Cohen is a full service CPA firm. They're here in Rockville, Maryland. They offer a full suite of tax and consulting services for entrepreneurs, really all around the country. One of their partners, Don, is a gentleman that I work with. He's been doing due diligence for private equity firms for 30 years. And so he helps us really take apart a client's financials and put them back together in a format that buyers are looking for. He's been involved in, over 30 years, hundreds of deals. So we're actually interviewing Don later this week. He'll be on an upcoming episode, and he'll talk about deferred revenue, tying your P&L to your balance sheets, working capital, accrual-based accounting, GAAP accounting, all the things that a CEO should really, really know and understand. Or you should have a guy like Don or somebody like that can explain it, not so much to you, but to whoever is asking those questions, so that you can focus on running your business well.
Todd, thanks again. Always a pleasure. I look forward to future episodes.
Jeremy, it's great having you. Thank you.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.